Good day. You're welcome to F5 Performance Management class. This lecture is brought to you by 3V Learning Center. Now in F5, which is Performance Management, before we go into the outline of the topics, we'll be taking you through the ladder for ACCA. Now we have F2, P5 and P5, and F2, F5 and P5. There are other courses in ACCA, about 14 of them, which you have to do. But as related to performance management, we have F2. You might have been exempted from this course, and if you did this course, it will give you an insight into what we will be doing in F5. And with your good performance in F5, you'll be performing very well in P5. So you are not just learning this course to pass the exam, you are learning this course in order to give yourself an edge when you get to the P5 level. Now, under performance management, the first thing we have here is cost accounting and new development. Now, in this cost accounting and new development, in the F2 class, we knew different cost techniques, which we talk about absorption costing, and the rest of them. But when we come to F5 class, we now have different cost techniques, which are going to be an upgrade on the traditional. So we have things like what? ABC, which is activity-based costing, target costing, ABC, target costing, throughput, and a host of others. Now, these new costing development, these new costing techniques are an upgrade on the traditional costing techniques that were treated in F2 class. Now, when we go to decision making and linear programming, now we have different techniques under this topic that will help us for decision making. So we go to pricing. Now, the reason why we are going to be treating pricing under the performance management class is because our world is gradually becoming very much competitive. And for you to beat the competition, you will need to come up with products with good prices, not just good prices, good quality. So the more the competition, the more your quest to get the attention of your consumers. And because there are different substitutes, you as a producer or an entrepreneur, you need to develop good strategies, good pricing strategies to get your product into the market, and for it to have an edge also in the market. So that is what we are going to be treating here. So under this pricing technique, we will be talking about cost plus, marginal cost plus, opportunity cost, and the rest of them. So under pricing technique, we're also going to be talking about relevant costing. Relevant costing has to do with eliminating those cost components that are not relevant or that are not very important or do not add value or are not directly related to the production of a particular product. So we are only going to be picking the costs that are what? Relevant. So costs like sunk costs, which include machineries that might have been purchased before now, will be eliminated. Now, we now go down to the next one, which is decision making under uncertainty. Now, because we cannot reliably predict the future, we have to come up with this model or this topic. Now, decision making, how do we make a decision as a manager, as a management accountant? How do we make decision when we have uncertainty? So at this point, we shall be talking about risk analysis, sensitivity analysis. We'll be talking about maximin, minimax, and a host of others, expected value. Now, those are what we'll be doing here. Decision tree, those are what we're going to be treating under this topic. Now, we have budgeting types. Now, because we are operating in a highly competitive environment, we as a management accountant have to be good at what? Preparing a good budget. Because if your budget is not right, you cannot come up with a good price that will be competitive enough in the market. So in order to get a good price, in order to price your commodities or your product well, you need to prepare a good budget. Now, that is what we're going to be doing under budgeting types. Now, under budgeting types, we have different types of budgets. We have a ZBB, which is zero-based budgeting, which entails starting a budget from afresh every time you want to prepare a budget. We have incremental budgeting, which only entails adding a markup to the previous year's budget. We also have ABB, which is a product of the activity-based costing technique. We have it as activity-based budgeting. We also have rolling budget, which is what? Rolled month by month, or period by period, quarterly, and so on and so forth. So those are the budgets we'll be treating under these budgeting types. We also have fixed budget and flexed or flexible budgeting. So those are things we are going to be treating under this budgeting type. We have budgetary controls. These two are well aligned together. Now we have quantitative aids to budgeting. Quantitative aids to budgeting, I'm talking about certain techniques that will aid us while preparing our budget. So we are having high and low method, regression analysis, and trend series analysis. Now, these are different techniques which we use while preparing our budget. Now, the main aim of these three techniques, which can be used individually, is in order to break down our cost components. Our cost components could be just a single value, or we do not know whether they are fixed cost or variable cost. So with the use of each of these, we can actually break a cost into what? Into variable and fixed costs. So that will help us while making decisions about pricing. Now we have our standard costing and variance analysis. When the operation has finally been carried out, in order to measure, we need to now measure our performance with whatever standard we have placed before now. So at that point in time, we'll be doing what we call a variance analysis. Now, standard costing has to do with what? Preparing a cost, a particular cost for each of components, for each of our products. Now, this variance analysis is to check what is the discrepancy between our performance and our target, or what is the discrepancy between our performance and our standard. Now, at this point in time, we now, after getting the discrepancy, which is the gap, we now check out what ways are we going to use to close this gap. It could be a sort of removing non-value adding activities. So those are most of the things you'll be doing under standard costing and variance analysis. Now we'll go to performance evaluation. You as a management accountant, or you as a manager of an individual department, in order to check how well you are contributing to the overall goal of an organization, you need to be making what we call performance evaluation. Now, this performance evaluation will help to check how well a manager is contributing to the achievement of the company's objective. So, this performance evaluation will be divided into what? Financial and non-financial performance evaluation. The reason why we are having a non-financial performance evaluation is because this financial most times could be easily manipulated and does not cover the entire performance of an organization. It does not actually cover the entire performance of an organization. So we'll be using a set of models like the balance scorecard, the performance pyramid, and the performance prism at this point. Now, the last part of our topic is transfer pricing. Now, the reason why we are bringing this is a situation whereby a company is divided into different divisions. So at that point in time, in order for the decisions of each divisional manager to be concurrent with the overall goal of the organization, we now have to set what price will be used to transfer products within the company from one division to the other. So at the end of the class, we are true, we are sure we are going to meet up and pass our exams. So 50% might be your target, but we can target what? 80%. This is for pass, but at the end of the class, we assure you this is sure.